Welcome back to the practice exercise to prepare the company's pro forma balance sheet. Then we finished it how to create the budgeted income statement to project it every month, right? And then the budgeted balance sheets are starting from the cash balance, always cash, current asset, and liability, and the equity, right? And then we balance out all the assets and liability and equity. And then we need to make sure equity account reflects each month's net income. This net income should be included in the owner's equity, right? That owner's equity includes also retained earning. All the net income accumulated is retained into the retained earning. And then we need to calculate cash account balance, and we already calculated on the cash budget, the schedule. And then I also indicated that the letters, the indicators, where this number should the be collected. Here, let's get started. From the cash budget, here we have the ending cash balance already calculated, right? Then the accounts receivable. Accounts receivable is the credit sales of that month. And then accounts receivable on the schedule A. There you go, the credit sales, right? And then the merchandise inventory, the ending balance of inventory is from the schedule B. The ending balance, where is the ending balance? There you go, ending balance. And then we collected this and write up the balance. And then prepaid unexpired insurance, as you read the descriptions, the company prepaid insurance, this insurance fee, right, for throughout the year. And then every month, once they received this insurance service, that prepaid insurance expense, which is asset account, should be amortized, right? Then how do we reduce this amount? Should be reduced by, right, 460 every month. And then total asset, current asset is those up. And then gross PP&E is from 85,100. Then we remember that the company purchased, right, from schedule D of this capital expenditure of the truck, right? And then it should be added. And then depreciation, the accumulated depreciation of private month should be increased by the depreciation on the income statement, right? Then we increase this depreciation, the accumulated depreciation accordingly. And then the sum of this total net PP&E is just to sum these two up. The total asset is total current asset plus net PP&E. So we have this total asset balance. This asset must be equal to total liabilities and equities. Accounts payable. How do you get the accounts payable? The accounts payable is from schedule B, right? Schedule B. Let's go to the schedule B. Purchased, that create accounts payable, right? Purchase. Schedule on the schedule B, here you go. We have the purchase, right? Then minus, here 50% of this month's purchased is paid, dispersed, right? But the remaining balance is accounts payable then. Okay, in the same way, accrued the wages and commission payable on the schedule C. Here you go. How much is the total wages and commissions? Again, this out of this the total wages and commissions, the company pays, right? The disperse the 50% of this expense. But the remaining amount, right? Remaining amount is accrued expenses should be paid next month. Okay. And then loan balance from Schedule D, the company now increased loan balance. Where's the loan balance remaining? There you go, right? And then we have total current liabilities. And then owner's equity also should be now increased or decreased by net income or loss of the current month, or is cumulative retained. So 181, and then total liabilities and equity should be sum those up. Current liability, total current liability plus the company doesn't have long-term liability. This, and then as you can see that we balanced out. Now let's drag to the right. Okay, then we exactly match it. All the total asset and liability each month. Then let me just double check if we link all these numbers correctly, right? And then accounts receivable from Schedule A, and merchandise inventory, ending balance of the inventory on the Schedule B, and prepaid. Now the prepaid insurance doesn't have, right? Because there's no more the asset, prepaid asset, because we paid out and then all this insurance covered throughout this year. And then the gross amount doesn't change because the only purchase of this property plant equipment incurred on April 1st, right? And then doesn't change. Accumulated depreciation is increased by, right, 1,150 every month. And then net PP&E, we got it. Then total balance of asset and accounts payable on the purchase schedule B. Now the purchase inventory minus the 50% of this month's purchase, so remaining is, right, the accounts payable. And then accrued wages also the same the same way. Then we collect all this loan from cash budget, remaining loan, and then finally the total liabilities and equities. And then the owner's equity increased every month by the net income or net loss of the current month. And then we balanced out. Okay, very good job. And see you in the last video clip to cover this budgeted statement of cash flows, and then we'll discuss about the net cash build or burn. Guys, bye bye.